It's a fact. No trader wants to make mistakes. No trader wants to make trading mistakes because trading mistakes cost money. And so every trader wants to do things that avoid mistakes. And so how do you avoid mistakes? In fact, how do you recognize a mistake before it happens? Well, in order to recognize trading mistakes, I've made a free course that's on my site right here at timelessdollar.com. Just go to the link Trading Resources and drop down to Free Trading Course, and it's right here, Avoiding Costly Trading Mistakes. It's absolutely free, and why would you not take a course that's absolutely free that's all about how to avoid costly trading mistakes, and especially if you are a new or novice trader or even an intermediate trader. Mistakes happen to all of us, but if you put the odds in your favor by making fewer mistakes, your trading success will improve. Makes sense, right? Now, as traders, it's also important to put the odds in your favor. So how do you put the odds in your favor? How do you have a greater percentage of winning trades? Well, to do that, first of all, I'll tell you flat out, you shouldn't be trading every day. Very few days are good trading days. And by that, I mean trend days. Trend days are difficult to spot, but sometimes they're not that difficult. For instance, on Friday, February 2nd, the U.S. Labor Department report was due out at 8:30 pre-market, the U.S. non-farm payroll report, and the forecast was for the economy to add 185,000 jobs. Okay, 185,000 jobs were forecast. So what did the report actually come out as? 353,000 jobs were added to the Labor Department report. Now, does anyone think that the market is going to go down when a report like this comes out with such fantastic news in terms of the forecast versus the actual? So anyone who traded to the downside on Friday, February 2nd, that was a huge mistake. Now, one of the things that I'm looking forward to is the Super Bowl. The Super Bowl is a once-in-a-year event, and it's going to be fantastic this year. You know, Travis Kelce and his romance with Taylor Swift has been well popularized, and I've been thinking about Taylor Swift, but there's another Taylor that you as traders should be aware of, and that's George Taylor. And if you don't know who George Taylor is, he was a trader that developed a method of analyzing the market and predicting where the market is likely to trade. And so I'm going to go to my chart. This was my chart of Wednesday, January 31st, and this was an FOMC day. And if you're a relatively new trader, please, FOMC days happen 8 times a year. Don't trade on FOMC days. And I'm not going to go into it why, except to say there's very erratic price action, very wild swings on FOMC days. But even on FOMC days, if you do trade, you use the Taylor trading zone and transpose it to the intraday high or low, whatever the case may be. And the intraday high or low is usually put in early in the day within the first half hour to an hour. On the case of Wednesday, January 1st, it was put in January 31st, it was put in right at the market open. And so the range was pretty narrow on Friday, January 31st. So only 21 point range. But look at this. You see this? If you use Taylor, if you knew how to use Taylor, you'd get on the market somewhere over here after you took an estimate that this was going to be the intraday high. And where do you get off? You get off right over here. Don't be greedy. You get off where the numbers say you should get off. Now on Thursday, February 1st, the market traded it opened up sort of in the middle of the trading zone. The previous close was down here at 48.69. But where do you trade? If you were going to trade on a Thursday, Thursdays are not such great days for trading. There's reasons for that, but I won't go into that. And where do you get off? Say you get in somewhere over here, you see the hammer down here and you get in. Where do you get off? You get off over here. You get off over here and forget about the rest of it because the numbers say this is where the market should go. Now, again, on Friday, after that fantastic Labor Department report came out, the trading zone was down here. The market briefly opened up right at the resistance line of the trading zone, but traded above it. So again, we transposed the trading zone to the intraday low. And the intraday low was right over here. And so where do you get off? If you're trading somewhere over here and you know it's going to be a fantastic day because the market had blowout news to the upside, where do you get off? You get off where the numbers tell you to get off. So how do you get the trading zone? Well, the Taylor Trading Calculator is also available on my site at timelessdollar.com, and you can get it right over here at this link or this link down here, Taylor Calculator. So if you're a fan of Taylor Swift, you're going to love the Super Bowl. If you're a fan of money, you're going to love George Taylor. So that's my video for today. Arv Eisen for Timeless Dollar Trading Academy. Trade safely, use lots of patience. Thanks for watching, and I'll see you in my next video.